Capitalization costs when we're looking at long-term tangible assets, also known as property, plant, and equipment. Property, plant, and equipment includes items required for use in operations and not for resale. They are long-term and are expensed through depreciation, excluding land. They possess physical substance. These are the characteristics of anything that's categorized as property, plant, and equipment. Let's now look at some examples and determine how the costs are recorded based on generally accepted accounting principles, also known as GAAP. Land. We capitalize costs associated with the purchase price, the closing costs, getting it ready for its intended use, any assumptions of any liens, property taxes, or encumbrances, and any improvements that have an indefinite life. Now let's take a look at a piece of property that was purchased, and let's first look at the rule. The rule is we must capitalize all costs associated with getting the asset ready for its intended purpose. So we had previously bought a building and land, and the following additional cash expenditures were incurred. We did repairs to the building, we constructed a base for new equipment, we installed driveways and parking lots, remodeled the building, including walls, and there was a special assessment by the city on the land. First, we determine what category of PP&E the items belong. The repair on the buildings should be going to the building. Construction of a base would be for the equipment. Installation of driveway and parking lots would be considered land improvements. They would not be part of the land because they have a definite life. Now, if we planted a tree, that would be part of the land because that usually is associated with an indefinite life. Remodel building, including walls, we would include in building, and then a special assessment by the city on the land would be capitalized as part of the land. Now, any ongoing property taxes after acquisition would just be expensed. The next thing we do is our journal entry. We would book to the building $266,000. The equipment would get $135,000, the land improvements $122,000, and the land $18,000, and the offset would be cash. Now, what happens if things are donated to a company? The rule is donated assets are booked at fair market value and treated as revenue. Our example is the city of Pebble Beach gives the company 5 acres land as a plant site to encourage them to build a facility in their area. The fair value of this land is determined to be $81,000. Our journal entry would be land $81,000 and contributed revenue, and that would be on the income statement as part of other, of $81,000. Now, what happens if an asset is purchased by stock that is widely traded? The rule is we book the asset based on the fair market value of the stock or the asset, whichever we are more likely to be able to determine. So let's take a look at our example. We have 12,500 shares of common stock with a par of $100 were issued in exchange for equipment, land, and buildings. The stock is widely traded with a market value of $168, and the fair market value of the land is $800, $400 for the land, and the equipment is $800, the land is $400,000, and the building is $1.2. So in this example, what we would have to use is the stock, since that's readily determinable because it's widely traded. So we'd use the stock value, and what it means is the total amount that we could book for these 3 separate items would be $2,100,000. Now, when we add up the $800,000, the $400,000, and the $1.2, we get $2.4 million, but all we can book is $2.1 million. So what that means is we have to allocate the 2.1 based on the fair market value of the assets. So we have to assign the $2,100,000. So what we're going to do is we're going to take the asset, the fair market value of each asset, divide by the total fair market value, gives you a percentage, and then you're going to take this times the assigned value, which is the 2.1, which will tell us how much we're going to allocate to each asset. So the equipment would get $700,000, the land would get $350,000, and the building would get $1,050,000, and that would be our journal entry. So our journal entry would be equipment, land, and buildings at the new assigned value. We would do the common stock at the par, and the difference would go to additional paid-in capital. Next, what happens if we had instead purchased the asset and the stock is not widely traded? Well, the rule again is we have to use whatever value is better, and in this case it would be the same problem, but we would use the fair market value. So again, we do our test, and in this case, the fair market value of the equipment is better because the stock is not widely traded, so the value would be not as good as the fair market value. So here's what we would end up booking: the land, the building, and the equipment at, which is its fair market value. So in this case, our journal entry would look like this. We would book the equipment, land, and building at the fair market value. The common stock again would be based on par, and the difference would go to additional paid-in capital. Now, what happens if we have a self-constructed asset? So the rule is, if the asset is self-constructed, you include all costs incurred getting it ready for the intended purposes, including a prorated amount for overhead, up to the fair market value of the asset. So now let's take a look at an example. In this case, a company constructed a piece of equipment which included the following costs: direct materials, direct labor, factory supplies, excess overhead caused by the construction, and an additional allocation of overhead at 60% of our direct labor cost of $15,000. So what would be the journal entry for the equipment if the fair market value is $44,000 versus what if the fair market value is $39,000? So let's take a look at this. First, we're going to look at what is the total cost to us of the equipment. We have our direct costs, and then we have our overhead, which is factory supplies of $900, excess overhead caused by the construction of $27, and an allocation for overhead of $9,000, giving us total overhead of $12,600. When we add that to our direct costs, we get a total cost of $40,100. The fair market value is $44,000, but we're going to use the lower of the two, so the equipment would be booked at the $40,100. Now, what would be the journal for the equipment if the fair market value is $39,000? We would go through the same process, and we'd get our $40,100, but since the fair market value is less, then we would use the $39,000. So again, you have to look at, compare the fair market for the cost. You cannot book it for more than what you spent, but you can book it for less if you spent more than you should have instead of just buying the equipment. So that includes part one of property, plant, and equipment.